Good afternoon. It's Jeffrey Christian of CPM Group. It's about 12:20 here in the afternoon in New York on Tuesday, the 5th of December. I want to talk and focus on the long-term Platinum Group metals outlook. CPM Group has just finished a update of our long-term report, which takes supply, demand, and price projections for platinum, palladium, and rhodium out to the year 2050. We take it out to 2050 because the impact of the energy transition and the trends that we expect in motive propulsion systems, the movement to electric vehicles at the expense of petroleum-powered vehicles, is a much longer type of transition than a lot of people think, and then would be covered really by our more traditional 10 years of projections. So we've been taking our Platinum Group metals projections out to 2050 for at least 6 years now, and will continue to do so. We've just completed an update. This is a report that's about 95 pages, and it's a more expensive project that we produce related to PGMs, and that's because people who buy it and trade based on it have traditionally made millions, if not tens of millions of dollars, understanding the PGM market in a granular way compared to what they get for free from marketeers. We also have our annual Platinum Group Metals Yearbook, which is a much lower price point review of what's going on now. Doesn't have projections going out 27 years. And then our monthly Precious Metals Advisory, which contains information on platinum, palladium, rhodium over the next 2 years. So we do have those kinds of reports. Now, before I do that, I want to talk, I think I'm obligated to talk a little bit about gold's price moves on Monday. The gold price shot up Sunday night in New York time, but Monday morning trading. When the gold COMEX trading started again, resumed electronic trading at 6 p.m. New York time, Eastern Standard Time on Sunday. After about 18 minutes, the price shot up. And the price shot up about $55 between 6:18 and like 20 minutes later. It was a number of transactions that went on. Then, subsequently later in the day, the price fell about $120. So I want to talk a little bit about that. But before I do any of that, I want to share something it's not about precious metals, but it relates very importantly to investing based on knowledge, the state of our world, the state of the United States, the state of people's knowledge, the state of people's willingness to actually learn things before they act. And here's what it is. You've probably heard or seen skits about it or jokes about it or newspaper editorial cartoons about it. You've probably heard that U.S. males think about ancient Rome several times a day or several times a week. This is a meme that's been going around, and it's gotten such circulation that everybody knows it. Well, as I was sick over the Thanksgiving holiday weekend, I asked myself, where'd that number come from? So I looked it up. It was an influencer. Now, somebody explained to me that an influencer is someone who can't get a job handing out free samples of fudge in a mall. It was a Dutch influencer who said it just off the top of his head. American males are thinking about ancient Rome all the time. No statistics behind it, no survey, no questionnaire, no poll. Yeah, it just off the top of his head. And it gained currency, like a Bitcoin or cryptocurrency, out of thin air. In other words, it was fabricated by a moron, and everybody now believes it. as I said, it's not about precious metals, but it's definitely about the way a lot of people approach precious metals investing. Now, let's talk about gold and what happened. In the price of gold through yesterday, 2020 through yesterday, you can see, we rose very sharply in 2020, reached a record high, came back off, reached a record high again in 2022, came back off, reached the record high in early 2023, came back off. We had traded up to about $2,093 on Friday's close. And what happened was that Jerome Powell said, markets have gotten overly enthusiastic and ahead of themselves in expecting Federal Reserve Board to cut Fed funds rates. We are approaching, if we haven't already reached, the peak of our interest rate increase cycle. We reserve the right to increase our interest rates further if the economic environment shows that we should, and we reserve the right to lower interest rates if the economic environment weakens. But any decline is probably at least 5 or 6 months away. The market consensus, if you look at the Fed Watch, suggests that the Fed funds rates will basically be unchanged, most likely, until March or May. 25 basis point declines possible if you look at the way financial institutional investors and banks are trading treasuries right now. Maybe a 25 basis point decline in March, and maybe another one, or maybe the first one in May. So very low declines and months away. But if you look at precious metals, gold had risen to $2,093. The stock markets has risen. The S&P and Dow are approaching their previous record highs. Financial markets have been acting as if there was an imminent likelihood of an imminent decrease in interest rates. And on Friday, Jerome Powell said, that's probably not going to happen, and these guys are going to get disappointed. That put a lot of concerns about the stock market into the markets just as they were closing. On Sunday, you had some problems with a U.S. Frigate in the Red Sea and the Houthi rebels in Yemen, which raised the prospect of Iran, backed by China and Russia, succeeding to create a second war for the U.S. In the Middle East on top of the Ukraine war. And that also sort of put the concerns in about the stock market and also drove some stuff. So when the markets reopened Sunday night in New York, Monday morning in Asian markets, there were a lot of computer-generated trades that had said, whoa, we closed above $2,090 on Friday. We should be buying gold. It's interesting and it's important to note it wasn't just gold that shot up. Silver rose, platinum rose, petroleum rose. The S&P 500 indices fell. So you had a broader-based set of large movements, which suggests it was nothing specific to gold. It was something exogenous to each of those markets. Now, if you look at it, in the first 2-minute trading period after that, at 1816, there were 4,021 contracts traded on the COMEX. And those contracts may have been short covering, or they may have been fresh long buying. Doesn't matter. They drove the gold price up a total of $5.70. Not so much. The second 2-minute period saw another 2,844 contracts trade. Again, you don't know if it was short covering or fresh long buying. And that caused the price of gold to rise $7.90. So you're about $15 up after 4 minutes of trades and 6,000, 7,000 contracts. And it's very important to understand, those were not one entity trading 4,000 contracts. That was a plethora, hundreds, if not thousands, of computer-generated trades being put in place saying, hey, the price has risen over $2,090. Let me buy or let me get out of my shorts. Right? The third 2-minute period saw 2,596 trades, and the price rose $13.20. The race was on. So you started to see these technically charged trades coming into the market, and over a 20-minute period, they drove the price up $55 to a record $2,152. By the end of trading on Monday, the price had fallen as much as $120 from that level. It recovered a little bit. It was trading around 2,040, and I think it's trading around 2,036 right now. Silver also rose sharply, as I said, and then it came back off. It's trading around 2,450, I think, as we speak. So that's what happened on Monday. Now, I really wanted to talk about long-term PGMs. These are the trades. You can see them if you can read them. I really wanted to talk about long-term platinum group metals, platinum, palladium, and rhodium. CPM Group has revised our work on supply-demand data, likelihood, and what they mean for prices over the long run. And what we're looking at is a market, in the platinum market. The reality is that the platinum market is in a surplus. You don't see the platinum price fall from $1,000 to $900. It's about a $905 right now, with a 1,000,000-ounce deficit. That deficit is not reflected in the price activity that you've seen on the platinum price. So something suspect there. We know what it is. We won't bore you with the details. The reality is the platinum market has been in a surplus. Now, you notice that the surplus is much, much smaller this year than it was over the last 4 years, really over the last 8 years. But it's something to pay attention to. No deficits here. We take our supply and demand projections for platinum, palladium, rhodium, other markets, and we say, what's likely to happen? And over the next 27 years, what we're looking at is increased supply of PGMs for the next few years, somewhat higher, greater palladium increases there relative to platinum. But on a long-term basis, constrained supply. And then a decline in supply of platinum, palladium, and rhodium, really maybe not starting to really appear until the end of the 2020s. But then a long-term decline in supply. That long-term decline in supply will have a number of factors behind it. One of them will be declining demand. Platinum, palladium, rhodium, their primary use of all three metals is in automotive catalysts used to clean up petroleum-based fuel exhaust in vehicles and stationary applications. The petroleum as a source of energy is going to be the major source of energy for the next 27 years. In 2050, petroleum products will still be the major source of energy for the world, which has important implications, negative for climate change and carbon dioxide emissions, but very positive for PGMs. That means that if you take our projections of automotive demand, you're still going to have about half of the vehicles being produced and bought in 2050 using either diesel or petrol, gasoline, right? That's going to keep demand up, but you're going to have lost half of the auto market. You've already lost about 13% of the auto market to electric vehicles, and those electric vehicles don't need PGMs. So you're going to lose another 40% of the market over the next quarter of a century, and that's going to reduce demand, fabrication demand, as opposed to stock demand or investment demand, where the metal stays as platinum, palladium, or rhodium in refined inventories that can be resold on a moment's notice. You're going to see fabrication demand fall, and that's going to have downward pressure on prices, And that's going to have downward pressure on supply because mining companies will say, hey, wait a second, we can't really justify building new mines. And people who recycle platinum group metals from auto catalysts will have less feed because a smaller percentage of cars being deregistered and taken off the road will have catalysts from which the platinum group metals can be recycled. So you're looking at lower demand, constrained supply, and prices probably overall will be weak. Now, there will be periods of price spikes, at least in platinum and palladium. And in the case of palladium, there could be some significant increases. But it's primarily, if you're a long-term investor, you should be looking at platinum, palladium, and rhodium and say, okay, these are not buy and hold metals anymore. I should expect the price by and large to move downward for all three metals over the next quarter century. If I'm a more facile trading-oriented investor, I might say I'm going to watch out for those periods of time when supply is falling faster than demand and you move into a deficit and the price can rise at least for several years before coming back off. So these things aren't dead as investment products. They are useful as investment products for facile trading-oriented investors. They're not necessarily attractive as buy and hold, and my heirs will have this metal. And that in turn has important implications for the prices, because in the case of platinum and palladium, you have a lot of metal held by investors in refined form at long-term investments. And if they catch on as to the long-term likelihood that the prices are not going to rise as sharply as they have in the past, then they may sell that metal, adding to the downward pressure on prices. That's what I've got this week. Again, if you're a client of ours, you can get these market alerts that we've done, the long-term economic outlook, which talks about a variety of economic and political factors, and that is underlying our long-term projections for gold, silver, platinum group metals, manganese, molybdenum, tantalum, niobium, copper, lead, zinc, aluminum, nickel, tin, petroleum, other commodities that we project. If you are a client of ours, you can get those market alerts. We did another market alert yesterday on what happened in the gold market, which we sent out to our paying clients. Tomorrow we'll be doing our open forum. If you're a client, you can plug in. You can send us by email questions ahead of time. We don't have any fixed format that we're going to be using. You can also ask questions live during the open forum. It's 11 o'clock tomorrow. We already have probably more than a dozen questions that have been sent in, so we'll have those to address as well. You can go to our website. You can buy our yearbooks. You can buy other research. You can become a retail investment client. And you can also send an email to info@cpmgroup.com saying, I want to talk to you about how you can help me improve my investment performance or my exposure to precious metals and commodities. That's all I have right now. Take care of yourself. Take care of everybody else around you. And take care of the broader spectrum of people around you, by which I mean the entire world. We'll talk to you on Friday.